When is your next assessment?
On the 16th or 17th, I'm not sure, around there, because I'm writing two. Other ones on the 16th, other ones on the 17th, so I'm not sure which one is which at
And
this
then the
point.
last one?
The last one is on June June the 14th and 13th and 14th.
Okay, I see.
Yes.
Right. So let's look at this one here. Remember, I said we're going to go to question 2. The reason why I want to go to question 2, I also want to discuss property, plant, and equipment, which is IS 16. So the concepts behind that topic, I'm going to discuss them as we do this question. Right. The following list of balances is an extract from the trial balance of ProWorks Limited on 1 March 2016. Right. Then disclose the following notes to the annual financial statements of ProWorks Limited 2017. So first of all, we need to do the calculations. Is that right?
Yes.
Right. So I don't think we'll finish this question today. Maybe today we'll work on the calculations. Then next week we'll do the notes. Right. Now, when we talk about property, plant, and equipment, we are talking about the assets that are of a physical, tangible nature that are expected to be used for more than a year and which are not held for sale. They are usually held for use within the business and that are not, or they can be rented out, except buildings. We know that if buildings are rented out, they are no longer property, plant, and equipment. They will now be what? Investment property. Is that right?
Okay.
So, property, plant, and hello?
No, I'm listening, sir.
Okay. So under property, plant, and equipment, we've got things like land and buildings, plant and machinery, furniture and equipment, motor vehicles. All those fall under property, plant, and equipment. Now, our property, plant, and equipment, when we buy it, we record it at cost. And the cost of property, plant, and equipment would include the purchase price. We also add things like transport for transporting the property, plant, and equipment to our premises. We also add things like installation costs. We also add things like testing costs. Right. They will make up the cost of the asset. Right. Then subsequently, we can either use the revaluation model or the cost model. The revaluation model is usually used for land and buildings. Right. Land and buildings, they can be revalued, whilst other assets, like the buildings, like the property, machinery, delivery vehicles, they are usually depreciated. So we use what we call the cost model, whereby we record them at carrying amount being the cost minus accumulated depreciation. So in our question, we have to identify the items of property, plant, and equipment. So when we do a property, plant, and equipment, right, this includes the following. We have got land and buildings. We have got plant and machinery.
Plant and equipment.
Plant and we have got furniture and equipment. We have got motor vehicles. You can have other categories. For example, another entity can have buses as a separate category. An airline can have aeroplane as a separate category. So it will depend. A business that has got a lot of computers can even put computers separately from other equipment and have a category of equipment. So from the nature of the business, you will decide on which what to use. Is that right? So when we are doing the property plan and equipment, we have to determine the following. One, we will determine the cost. Cost of property plan and equipment includes the following. Purchase price, construction costs. Sometimes we don't purchase, we construct assets, including materials and labor. Import duties, if you are importing the assets that you are using. Installation costs. Some special type of plant and machinery might need installation, so we have to include that. Testing costs. Right, depreciation of assets used in manufacturing another asset. So if you manufacture another asset using another one, the depreciation for that asset used during that period will also be included in the cost of the asset. Right. Then you have to determine your accumulated depreciation. At the beginning of the year. Why? Because we need the carrying amount at the beginning of the year, which will be equal to cost minus accumulated depreciation. Right. Then we would also need revaluations during a year. Normally, revaluations, we have them, these days, they usually examine only on land. But we might find that in the questions that we shall deal with, they can be revaluation on land and also on buildings. But in our exams, normally they usually just deal with the revaluation of land. Revaluation, this is whereby our assets are revalued upwards by qualified persons. I think we know that although most assets depreciate, we've got one asset that does not normally depreciate. Instead of depreciating, it usually increases in value, which is land and buildings. So instead of providing for depreciation, we revalue it upwards. Right. Then we have got depreciation for the year. There are many methods that we can use. We can use the straight line. We can use the reducing balance. I think you shall see from the question what we mean when we say straight line and what we mean when we say a reducing balance method. All right. Then we will also need additions at cost. These are assets that are bought during the year. Any assets bought during the year. Then we'll have disposals. At carrying amount. When we say a disposal, this is an asset that is sold, or maybe we just do away with it. Maybe you can even throw it away. That's what we mean when we talk about disposals. So any disposals was supposed to record the net carrying amount. That is the original cost price minus the accumulated depreciation at the date of sale. Right. So now we want to look at our question so that if possible, we can be able to do all our calculations so that when we meet next week, we'll just do the note and also do the statement of financial position. Right. Let's look at the question. Right. The following list of balances is an extract from the trial balance of ProWorks on 1 March 2016. Our year is ending on 28 February 2017. Right. Land and buildings at cost, Boomspruit were given the land 400,000 and the building 6,398,400 and were given at cost. Right. We're told on number 1. The following information relates to owner-occupied land and buildings of ProWorks Limited. On 28 February 2018, ProWorks Limited acquired a factory and offices situated on ERF 401 Boom Street to be exclusively used for their own purposes. Right? When an asset is being used for the own purposes of the business, it will be considered property, plant, and equipment. So a tangible, non-current asset that is used for the own purposes of the business, we will consider it to be property, plant, and equipment. Right, the property was available for use as intended by management on acquisition date. On acquisition date, the useful life of the buildings were estimated to be 20 years, and the residual value of new was allocated to the buildings. Both the residual value and the remaining useful life of the buildings remained unchanged since initial recognition. On 1 March 2016, an independent sworn appraiser, Mr. J. Leon, revalued this property for the first time and determined the fair value of the land and the net replacement value of the buildings to be 600,000 and 6.4. Right. Our land, the cost was 400. And now, remember that they are being revalued for the first time, so they've never been revalued. And now it's now 600,000. So we can be able to calculate the land. So we can say right, so that's October, November 2017. Lesson 2. Right. So we start with our calculation. Start with our land. So under our land, we have revaluation, which is equal to the new value. Revaluation is simply the new value. That is the revalued amount minus the book value that we already have, which was 100,000. What do we get? 200,000. That is the only calculation that we have on the land. Any questions? Right. Then we've got the buildings. Right. Our cost, we know that the cost is 6,398,400. Right. Then accumulated depreciation. Right. First of all, we have to find our accumulated depreciation at 28 February 2016. We know that our year is ending in 2017, but when we do our PPE note, we would need the carrying amount at the beginning of year. So because of that, first of all, you have to determine your depreciation up to the beginning of the year. Right. So we're told that we have to go to the policy and hear how they are depreciating they are depreciating their buildings. Right. We are told that owner-occupied land and buildings are accounted for in accordance to with the revaluation model. Revaluations are made with sufficient regularity to ensure that the carrying amounts do not differ materially from the fair values at year end. On revaluation, accumulated depreciation is eliminated against the gross carrying amount of the assets. Any revaluation surplus in respect of depreciable assets realizes through the use of the underlying assets. Depreciation on buildings is accounted for in accordance with the straight line method over the estimated useful life of the assets. Depreciation is calculated on the most recent revalued amounts. Right. So that means, I'll explain what it means. First of all, from 2013, when the asset was acquired, we have to provide depreciation up to 28 February 2016, which is 3 years. And we know that the useful life of the building was 20 years and the residual value was nil. So to calculate our depreciation, accumulated depreciation on this date, we would say the cost 6,398,400 divided by what? 20. Then we multiply by 3 years, because from 28 February 2013 is 3 years. We should know that a depreciation, when we are applying using straight line method, this is what we call the straight line method, would be equal to cost minus the residual value times percentage. If we are given a percentage, or we can say cost minus the residual value. Sometimes we are not given a percentage, like in this case, then we divide by the useful life. Right, and we should know that depreciation is apportioned if assets was used for part of a year. For example, if we use our asset for 3 months, we would then multiply by 3 over 12. Right. So what do we get here?
959,760.
959,760. Right. That will give us our carrying amount at the beginning of the year. Which will be this one. Right. Then on that 1 March, remember at the beginning of the year, that's the 1 March. Then on that very date, there was a revaluation of the building, and the building was revalued to 6.4. That is on 1 March 2016. So they revalued it to 6.4. So we increase this building. So our revaluation would be the difference of 6.4 and the carrying amount, which is a 5,438,640. What do we get?
It's 961,360.
Right. We get what is called the gross carrying amount.
961,360.
Okay, thank you. So we then get what we call our gross carrying amount. That's the gross carrying amount. Right. So from now on, this asset will no longer recognize the cost of 6,398. It will now be recognized at 6.4. Even its depreciation from now going forward, it will now be based on the gross carrying amount. So our depreciation for this year would be 6.4. We will no longer use the 20 years. According to IAS 8 changes in accounting estimates, if there is a revaluation, we now have to depreciate the asset over the remaining useful life. We know that it was 20, but 3 years had already gone from 2013 to 2016. So we're only left with 17 years. So we divide by 17. From now onwards, we'll be using the 27, the remaining useful life, which is the 17 years. Right, what do we get?
Mm, 376,470.58. 376,470.58.
471 to round off.
471.
Yes. This will give us carrying amount at end of year. So this will be our calculation on the building. But you'd find that everything is still there, but they don't normally ask you about the revaluation of the buildings in your exam. Any questions? Right. Then we go to the next calculation. Number 2, the following information relates to investment property of ProWorks Limited. On 1 March 2016, ProWorks Limited acquired a property situated on Stand 65, Fordsburg, at a cost of 3.2, land 1 million, building 2 million. Additional expenditure of 30,000 was incurred to secure the 2 tenants that occupied the building since the date of acquisition. Improvements to the building to extend the rentable floor capacity amounted to 400,000 were completed on 28 February 2017, including repairs and maintenance of 50,000. Right. On 28 February 2017, Mr. M. Honor, an independent sworn appraiser who holds a recognized and relevant professional qualification and has experience in the location and category of the property being valued, determined the fair values of this property as follows. Land 1.1, buildings 3 million. Right, so this one is a investment property. A property that we are renting out, it's called an investment property. And actually they told us that this is an investment property. So investment property, normally in your module, they don't usually depreciate it, but practically it can be depreciated. So you can check the policy of this entity. We are told that the policy of the entity regarding investment property. Investment property is accounted for in accordance with the fair value model. So they are using the fair value model. With the fair value model, there will be no depreciation. They just determine the fair value adjustment, which will be the difference between the new revalued amount according to the expert and the old value. Like our land, it was 1 million, but it was bought, it was then revalued for 1.1. Right. So on our land, let me just do the calculations also of the investment property. So please, this will not be a PPE. This asset will be investment property. And it will not be disclosed under PPE. Right. The land portion, land will have a fair value adjustment. Which is equivalent to the difference between our new value according to our expert 1.1 and the original. Okay, just a minute. Just a minute. Can you give me a minute? Sorry, guys, I had to attend to something urgently. Right. So we're saying the cost was 1 million.
Sorry, sir.
Yes.
Can I please disturb you?
Yes.
I'm just wondering, I'm asking myself for since we are doing the depreciation according to the straight line method, why does the depreciation for the previous years matter?
What I think?
I'm saying since you are they said the depreciation here is according to the straight line method. So why does the depreciation from the previous year matter?
Because you need the carrying amount at the beginning of the year when
So
you're
we're
doing your
taking,
property, plant and equipment.
oh, so we'll
So to
take
get
that
that carrying amount at the beginning of the year, you say cost minus accumulated depreciation. That accumulated depreciation will be for the previous year.
Okay. Okay, sir. Thank you.
Right. So now, so we're going to say the fair value adjustment on the land and buildings would be equal to the new value, which is on number 2 there, which is according to our school appraiser 1,100,000 minus the original cost price on number 2, the first statement, which is 1 million. We get what? 100,000. Right. Then we deal with the building. Right. When it comes to our building, we are told that it was bought for 2.2. But there was additional expenditure to secure tenants. Right. Expenditure that is incurred to secure tenants is not included in the cost of the building. We don't include it in the cost of the investment property. So that 30,000 will not be included in the cost of the investment property. Right. Then we are also told that there was an improvement. Improvements are included in the cost of the asset. When you improve your asset, you also include it in the cost of the asset. So they said it was 400,000, but it was including repairs and maintenance of 50. Repairs and maintenance are not part of improvements. Repairs and maintenance are not part of improvements. So we don't include them. So we would say to do our calculations on the building, that investment property, we can say the cost, which were given on number 2, that's 2.2. Then we add our improvements. We take out the portion of the repairs. Our improvements were given that the improvements were 400,000 minus the repairs, which are 50,000. We get 350,000. So repairs and maintenance are not included, and the cost to secure a tenant are not included in the cost of the property. Right, so that means the total cost would be equal to 2,550,000. Right, then our fair value adjustment will now be the difference between the 2,550,000 and the value established by our expert, our spoon appraiser, which is 3 million. So we'd say 3 million minus 2,550,000. What do we get? I'm waiting for you guys.
Oh, I beg your pardon, you said
3 million
450,000.
minus 2,550.
450,000.
Right. Then we get our carrying amount in the here. So that's what we do with investment property. We just find the difference between our new value is determined by the sworn appraiser and the book value that will be our evaluation. Right. So these are the calculations regarding the investment property. Do you have any questions? Right. Next. We also have plant and machinery, which is question 4, but maybe on 3 I also saw something here. On number 3, we are told that all the delivery vehicles were acquired on 1 March 2014. Remember that our year is starting 1 March 2016. So before this year, they'd gone for 2 years. And they were all available for use on this date. A residual value of new was allocated to all the delivery vehicles on acquisition. The carrying amount of the delivery vehicles on 1 March 2016 amounted to 960. The following delivery vehicles were acquired and sold during the current financial year. Right, on 31 August 2016, one of the delivery vehicles acquired on 1 March 2014 with an original cost price of 240,000 was sold for 200,000. The accumulated depreciation on this vehicle on 1 March 2016 amounted to 96,000. Right. Then a new delivery vehicle was purchased on 28 February 2017 at a cost of 110,000. 14% VAT included to replace the above mentioned delivery vehicle, and it was immediately available for use. A residual value of new was allocated to the delivery vehicles on acquisition. You can assume that ProWorks Limited is a registered VAT vendor. Right. Then we are told that depreciation on delivery vehicles is accounted for at 20% per annum using the what? Straight line method. 20% using the straight line method. Right. So now, if they are using the straight line method, these assets had a carrying amount of 960, and they had been used for 2 years by this date, 1 March 2016. Where did I get the 2 years? Because they were bought in on 1 March 2014. So we can be able to find the original cost price. Delivery vehicles. Right. We can have our original cost price. We can say the value that was given on number 3, which is 960,000, then we multiply by 5 years and divide it by 2, sorry. Multiply by 5 divided by 3. Where is this coming from? It's coming from the fact that these vehicles are depreciated at 20%. If you say 100% divided by 20%, that will mean that they've got a useful life for 5 years. They have a useful life for 5 years. 100 divided by 20. Please, you only do that if they say it's straight line. So their useful life is 5 years. But 2 years have already gone from 1 March 2014 when they were bought up to 1 March 2016, the beginning of the year. That means this 960 represents the value for the remaining years, which is the 3 years. So for me to get the original cost, I just multiply by 5 the original useful life and divide by 3 the remaining useful life. Then I can get my original cost price. So that means my original cost price is how much?
It's 1.6 million.
That means these vehicles were bought at 1.6 million originally. So you just have, if it's straight line, you just have to multiply by the original useful life and divide by, if you are given the carrying amount. If you are given the carrying amount, to get the original cost, you multiply by the original useful life and divide by the remaining useful life. Right. Then we find our depreciation for the year. We know that is 20% per annum. We have got 3 categories of vehicles. We have got old and existing. Right, our vehicles were for 1.6, but the company sold one of the vehicles which had a cost of 240. So the ones that are remaining, the old vehicles that are remaining would be 1.6 million minus 240. Right, then we multiply by 20% our depreciation rate. What do we get?
Five, 440. Eh?
Like this.
I'm getting 270,000.
272,000.
Mm-hmm.
I think it's around 272,000. I think it's
Yes,
that can be correct. Right. Then the one which was sold, we will still calculate a depreciation on it. 240,000 times 20% multiplied by, right. During this year, the one which was sold, we didn't use it for a full year. We only used it up to 31 August 2016. So we count the months from 1 March 2016, the beginning of the year, up to 31 August. We find that our months were from March to August. That's how many months? 6 months. So we only used it for 6 months, March to August. So multiply by 6 and divide by 12. What do we get?
$24,000.
24,000. Right. Then the new vehicle. Right. The new vehicle, it was bought on 28 February 2017 at 14,400, including VAT. Right. So we have to take out VAT in the cost of the asset. We take out VAT. Right. And remember that it was immediately available for use. So it was bought on 31 August. So it was used for the remaining 6 months. Right. And this business is a VAT vendor, so we have to take out the VAT from the cost. But if the business was not a VAT vendor, we're not going to take out the VAT. Is that right? So we're going to say 14,400. To take out the VAT, we multiply by 100 divided by 114. In this case, they were using 14%. Then multiply by 20%, our depreciation rate times the remaining month, 6/12. Because they are saying that it replaced the other vehicle, so immediately they bought another one on 31 August 2016, so which was used up to the end of the year. What do you get?
$36,000.
Right. Then we get our total. Right. Then we also need to know our disposal. Disposal is the carrying amount, a recorded carrying amount. All assets that are sold should be recorded in carrying amount. Now we know that the asset which was sold, the cost was 240,000. Then the accumulated depreciation. Right. We know that at the beginning of the year, we had been given the depreciation. The accumulated depreciation on this vehicle on 1 March was 96. But there was further depreciation up to August of 24. So you can say 96,000 plus 24,000. We get 120,000. Then we get the carrying amount. So whenever we sell an asset, when we sell an asset, it has to be removed at its carrying amount, which is cost minus accumulated depreciation. So we are going to see where we are going to include this amount in our property, plant and equipment. So we need this amount because it should be included in the property, plant and equipment note. We should include all the assets that were sold at their carrying amount. We should remove them from our asset books. Any questions on the vehicles then? Right. Then finally, the last calculation on this would be on the plants and machinery. What we know that the cost was 1,920 and the accumulated depreciation was 384. Then we were told that on 1 September 2016, ProWorks purchased a new machine at a cost of 600,000. The machine was available for use as intended by management on acquisition date. On acquisition date, a residual value of 400,000 was allocated to the machine. Right. So if they didn't say that it was not recorded, so we assume that that 600,000 is included here in the 1920. So unless told otherwise, we assume that it's already there. Right. Then we know that a depreciation on plant 20% according to the reducing balance method. And we know that when we're using the reducing balance method, right, our plant and machinery, right, and I think before I forget, we also have to calculate the addition here. That asset which was bought at its cost excluding VAT, that would be the 410, 400 multiplied by 100 divided by 114. Because when you do your PPE note, you would need to include any additions, and the addition should exclude VAT. How much was it?
For 60,000.
That means that asset was bought for 360,000. Right, okay, I'll come back to my plant and machinery. On the plant and machinery, the only calculation that we need, which is the depreciation for the year. So our depreciation for the year would be, we take remember that there's a new one for 600,000, which was bought, which is included in these assets. So we should take out, we should have first the new one, the old ones, which are the 1920 and the 384. We know that the depreciation is using the reducing balance method. So we would say, let's remember that depreciation using the reducing balance we say the percentage multiplied by cost minus accumulated depreciation minus residual value. Right. So our depreciation for the year, we've got the old machinery, would say 20% multiplied by the original cost, which was 1920. We take out the new one because we're saying as long as they didn't tell us, we assume that it's already included there. 600,000, then minus the accumulated depreciation, which is 384,000. What do we get?
One 187,200.
187,200.
Two.
Right.
200.
187 what?
200.
200. Then the new one would say 20% multiplied by 600,000. Let's remember that the new one has got a residual value. We are told that its residual value is 40, and it was bought on 1 September. So 1 September to February, that means we used it for 6 months. So minus 40,000 times 6 divided by 12. What do you get?
$56,000.
56,000. Then we get our total depreciation, which is this plus. So these are our calculations regarding property, plant, and equipment on this question. So review those calculations before we meet next week, and then that's when we'll start and do the. So we'll use these calculations to do our property, plant, and equipment, and we'll also use it when we do the statement of financial position. Okay, thank you so much. So review that work before we meet next week.
Before you leave,
Yes.
hey, I'm so depressed. I actually got a 0 on the first assessment. Do you think I still have a chance to pass?
What happened?
I don't know. Apparently, the script on their site appeared blank. But I wasn't alone, even though I tried to communicate with them. They're saying the IT department doesn't get anything, any problem. There was no problem, so they cannot